Today we're going to be talking about one of the most popular stocks on social media, and that is none other than Nike. The company also posted their earnings just a couple of weeks ago, so we will dive into some of those numbers, but I think what was more important from this earnings announcement was some of the comments from the new CEO, Elliott Hill. So we will take a look at some of those comments, go over what they could mean for Nike moving forward, and look at some of the partnerships that they could reignite that could lead to additional profitability and revenue for the company. And finally, to leave off the video, I want to take a look at potential price targets if Nike were to continue this trend down in revenue. I see all over YouTube cases around how this stock could double. I think it's important to consider what could happen if Nike continues losing revenue and losing customers. I do want to wish all of you guys a Merry Christmas and thank you so much for the support in the last couple of months. The channel is now 100 subscribers away from the 4,000 mark. That is a huge milestone. Thank you guys so much for the continued support. If you want to help us try and hit 4,000 before the end of the year, I think that's a stretch goal, but I would definitely appreciate it. Thank you guys so much for watching, and if you enjoy the content, make sure to subscribe. Before we jump into Nike, let's take a look at the YouTube portfolio. It's currently sitting at a value of $58,955.26, which is up a little bit because back on December 18th, the value of the portfolio dropped down to around 57,000. So over the last week or so, we've seen a solid rebound in stock prices. And a lot of that recent positive momentum has been driven by Palantir. Currently, this position is up almost 800%, followed by Apple as our second best performing position, up 400%, Microsoft up 300%, SoFi up 160%, PayPal up almost 50%, Visa has also performed very nicely in the last couple of weeks, up 20%, then Google, which is the newest position in this portfolio, which is up 16%, and then Alibaba rounding out the bunch, up 10%. I also hold two dividend ETFs. I have SCHD as well as VYM. SCHD is up around 13% and VYM is up around 20%. On top of that, I have almost $13,000 in cash. Right now, I'm potentially looking at selling out of one of these two dividend ETFs, probably in the new year, and moving that money into cash just in case any opportunities come up in the market. I think 2025 could be a bumpy year, and I want to be prepared if we see a pullback in the market. One of the reasons it is so crucial to keep cash on the sidelines is for opportunities like Nike. Nike is a stock that year to date is down around 28%. If we look at the last 5 years, it is down even over that time period, down 24%. And from its highs achieved back in 2021, the stock is now down 56%. However, there's a couple of things you need to keep in mind if you are going to use a contrarian style of investing. The first one being you need to trust the person in charge of the company. Nike has recently made a change of their CEO by adding Elliott Hill and getting rid of John Donahoe. Elliott Hill is a 30-year veteran of Nike and has a very deep understanding of what the company needs to be successful. The second thing though that you need to understand is the vision this CEO has. What is the strategy they are planning to execute in the future that will turn the business around? And it's clear from Nike's most recent earnings announcement that Elliott Hill has two main focuses. Nike needs to focus on sport as well as focus on their partnerships with retailers. And during the company's most recent earnings announcement, Elliott Hill made the following statement: "What I've seen is traffic in Nike Direct digital and physical has softened because we lack newness in product and we're not delivering inspiring stories. The result is we've become far too promotional. Entering the year, our digital platforms were delivering roughly 50% split of full-priced promotional sales. The level of markdowns has not only impacted our brand, but it also disrupts the overall marketplace and the profitability of our partners." What Elliott Hill is talking about here is that Nike's digital platform, Nike Direct, is driving a lot of promotional sales. That means they are discounting their product or marking it down to really get it out the door. There are two things with that. One is Nike has had an inventory problem, so it is great that they have ran these promotions and started lowering their inventory back to normal levels. However, this also impacts the brand. It makes Nike look like it is a discount brand where customers really don't have to buy right away. They can wait for the better deal. And it also impacts the profitability of their partners because they're only offering these promotions on their digital platform. They're not offering it to their partners. So a lot of these partners feel like they are getting the bad end of this deal because they are having their shoes on sale at higher prices than than where customers can get them on Nike Direct. This change of strategy back to a full price model is going to create some headwinds in the near term, and Nike is very aware of this. They're going to have to aggressively liquidate a lot of their old inventory through less profitable channels, which ultimately is going to decrease some of their margins. They're expecting their gross margins to be down 3 to 3.5% over the holiday quarter. And ultimately, until Nike starts driving some of these new product releases as well as strengthening their partnerships with retailers, they're expecting revenue to continue to fall. Their projection for next quarter is that they will see a sales decrease year over year of low double digits. Overall, Nike was able to beat top and bottom line estimates from analysts this quarter. However, those estimates were extremely low. They reported their earnings back on December 19th, and they came through with EPS numbers of 78 cents, which beat analyst expectations by almost 25%, and revenue came through at $12.35 billion, which beat analyst expectations by 2%. But when you look at those numbers on a year-over-year basis, they are still not great. That $12.4 billion of revenue is down 8% year-over-year or 9% on a constant currency basis. Nike Direct came through with $5 billion of revenue, which is down 13% year-over-year or 14% on a constant currency basis. Wholesaler revenue came in at $6.9 billion, down 3% on a year-over-year basis or 4% on a constant currency basis. This is actually one of their positive things, right? Their wholesaler revenues are not decreasing by the same amount as these other areas of the business. This is clear as to why Nike is looking to get back into a lot of these wholesalers, because that is the one area where they aren't seeing significant weakness. However, as Nike repositions back into wholesalers, they are going to have to give up some of their margins, and gross margins decreased 100 basis points year over year to 43.6%. However, if you are a Nike investor, I think a year from now, if I told you that you had to give up some of your gross margin as well as less of a focus on Nike Direct revenue, but you would see a solid increase in wholesale revenues, which ultimately will translate to higher revenues in totality, I think they would gladly make that trade. They made that trade 5 years ago. They focused on Nike Direct, and that helped improve their margins. Now what they are having to do is the reverse. They're going to have to backtrack on that, focus a lot more on their wholesalers, which ultimately is going to drive down some of their margin, but I think at the end of the day, that will get them back to top line growth. And this is the strategy that Elliott Hill plans to implement at Nike over the next couple of years. He even made the comment that a lot of these wholesale partners feel like Nike has turned their back on them. And one of those wholesale partners is Foot Locker. Foot Locker has had a rough 5 years in terms of their stock price. They are down around 45%. However, from their highs back in 2021 of almost $65 per share, the stock price has fallen by almost 70%. Foot Locker's top line numbers have been relatively flat over the last 5 years. Back at the end of 2019, they were bringing in around $8.05 billion of trailing 12-month revenue. That is currently sitting around $8.12 billion. They did see a peak back in 2022 of almost $9 billion of trailing 12-month revenue. However, again, that has decreased slightly over the last couple of years. However, in contrast, one of the other retailers that Nike has exited has been Dick's Sporting Goods, and their stock price has appreciated by 366% over the last 5 years. And that's because of very strong top-line growth. At the end of 2019, they were bringing in $8.6 billion of trailing 12-month revenue. That has since increased to $13.4 billion. And the reason I show you this is because this is all growth that Nike has missed out on because they have pulled out of a lot of these retailers. And you can see this very clearly from their numbers. A lot of people, when Nike was originally showing declines in revenue, were blaming it a lot on China. And this has definitely been true. They have seen 11% declines year over year for the 3-month period, as well as 7% declines in the 6-month period. However, as a total percentage of the revenue, China is very small. When you look at North America is almost 50% of their total revenue, and they are seeing declines in footwear specifically of 14%. That is over the last 3 months as well as over the last 6 months. So this isn't getting any better over time. And that's really why a change of strategy is needed for Nike. Right now, their trailing 12-month revenue is sitting at $48.9 billion. That is down from around $51.5 billion just a few months ago. However, this has been a continued trend for Nike over the last couple of years. They have seen really low single-digit to even negative revenues over the last 2 years. And this is something that is very different for investors, because if you look over the last 10 or so years, they have consistently been able to grow their top line by anywhere from 5 to really 15%. And that's what investors have come to expect from this company. And because of this consistent top line growth, investors were willing to pay a premium for Nike's stock price. However, more recently, this has changed. On a trailing PE ratio basis, they are trading at 23.69 compared to a year ago when they were trading anywhere from 30 to 35. And right now for EPS estimates, for 2025, analysts are expecting $2.16. They just reported their Q2 earnings, so they have 2 quarters to round out this fiscal year. For next year in 2026, analysts have an average EPS estimate of $2.65, a low of $1.57, and a high of $3.80. And this is really where we can come up with some price targets for Nike. Again, their average EPS estimate for 2026 is $2.65. That puts them at a forward PE ratio of 28.94. I think that a valid PE ratio for this company is really anywhere between 20 and 30 because that's in line with the market. That would put their price anywhere from $53 to $79.50 per share. If they were trading at a 20 PE ratio, that would equate to this 53. If they were trading at a 30, that would put them at the 79. However, I do think there's a possibility that this stock could underperform. They could see issues with executing some of the strategy that could lead to lower earnings. We've even seen that from the CEO. They've talked about the potential of decreasing margins. If they come through and they put up $1.57, that puts them at a forward P ratio of 48.85. If we see this stock underperforming as well as their revenue continue to decrease, I think there's a realistic possibility that Nike could trade at a forward P ratio between 10 and 20, and that would equate to a stock price with an earnings of $1.57 of anywhere between $15.70 and $31.40. The bull case is basically just the opposite. If Nike comes through and outperforms, they get into retailers very strong and they see strong growth, they get back to a trend of growing their top line numbers, and they see that also translate to bottom line growth, they could put up $3.80 of EPS. At that point, they could justify a valuation, in my opinion, between 25 and 30 in terms of a forward P ratio, which would put their stock price between $95 and $133. In my opinion, I think this underperform is a little overblown. I think that for Nike to get down to a valuation of 10 is probably unrealistic, but there is the possibility. We could see investors really pull back on some of their valuations and what they're willing to spend for this company, especially if Nike continues over the next couple of years to see either flat or negative top line numbers. That would be very detrimental to the stock. What I think a realistic bear case would be is the stock dropping to around $50 to $55 per share. That would again be a PE ratio of around a 20, and they'd have to come through and actually put their average EPS estimate of around $2.65 in 2026. I think that that could be realistic, and that would be a very bearish scenario. However, there is also the opposite side of things where Nike comes through, they outperforms, and they put up, a stock price of $133 per share. That's where you get to that double up scenario. But just keep in mind that there are bearish or even more bearish scenarios out there. And when you only hear about the top line, you just believe that these stocks can go up no matter what, and that you're going to make money no matter what if you put money into them. That is not the case. There are possibilities where these companies continue dropping even further. Sorry for all the negativity right before Christmas. I do hope you enjoyed the video though, and keep in mind this is just all my opinion. I'm just putting out there some possibilities of what could happen with this stock if things were to change. We saw in yesterday's video, or a couple days ago I guess it was posted, on going over Warren Buffett's hedge, where VeriSign over the last 5 years has seen a massive decrease in their valuation. And ultimately something similar could happen to Nike if investors decide that it's not worth the money and they don't want to pay as much for the stock. So just keep all that in mind. I do hope you enjoyed the video. If you did, drop a like down below and subscribe for more videos like this one. And as always guys, have a wonderful rest of your day and a Merry Christmas. And for the joke of the day, we have one final Christmas joke for the year. How do sheep say Merry Christmas to each other? Check the comments down below for the answer. Thanks for watching.